So today we're gonna talk about Wyckoff. So the people who don't know Wyckoff, let's just do the basic markups. So let's mark up Wyckoff, or let's do what Wyckoff usually looks like. So price is going down. Then we have the PS. The PS usually has a small move up. Then we have the SC. Then we have a move back up, which is the AR, the ST. Then another move up, maybe here or here. And we have an ST in phase B. Then we have some noise, Then we have the spring, and usually goes up slowly. Then we have the breaks of D structure, then which is the sign of strength. Then we have the last point of support. So let's mark this up. So we have so you have the PS, which is the preliminary support. Then we have the AR, which is here. Then we have the SC. So PS, SC, preliminary support, which is PS, SC, selling climax, AR, automatic rally. Then we have this. We have ST, which is secondary test. Then we have a lower one, which is called the STNB. STNB meaning ST in phase B. Then we have the spring. Then we have the sign of strength, which is this. Then we basically have the last point of support. LPS, last point of support. So that's your usual Wyckoff. Now for the beginners who don't know, so basically PS, preliminary support, PS looks like just a short move up before it goes down. Then SC looks like is a way more bigger move compared to PS. That's why hence we have this bigger move down. SC, the next is the AR. Usually the AR is never above the PS. So if it's, maybe it can do at least an equal high, but usually it doesn't go above the PS. Then we have the ST. The ST is always above, or it could be it also could be an equal low with the SC, but usually, ST should never be below SC, because if ST or the secondary test went below the SC, then it should be called an ST in phase B. That's why we have the secondary test in phase B. So we only have a secondary test in phase B if it breaks lower from the SC. So since it broke lower, then we call this an STNB. Then we have a rally up to create liquidity, so we can so we can trap out other people when we push down to create the spring. Now the spring, we call it a spring if it breaks lower than the ST. Then we have the sign of strength, or basically the break of structure of these points. Then it would be also great, it will be also more beautiful if we break above this structure point or tiny high from the PS or the preliminary support. Then we enter on the last point of support, which is, we look for an order block and we enter there. So basically remember that order block is the last down move before the up move, and vice versa, the last down move, the last up move, the last up move before the down move. That's how we see order blocks, right? Now let's do it again. So price is here, it goes down, we create a PS. Now remember, a PS is always a small retracement or just a tiny noise. Basically this is how usually PS looks like. Then we create an SC, selling climax, to create hype to those emotional traders or to those breakout traders because they see this breakout of these lows or the structure point. Hence, they immediately enter sells, market sells. Then they don't know that they got trapped by this basically a liquidity schematic or liquidity creation schematic. So we have the SC, which is a huge move down. Then we pull up to create an AR. Remember, an AR is usually doesn't go above or just creates equal highs from the AR. I mean the PS, preliminary support. It usually doesn't go higher above the preliminary support. Then we have the ST, which is the secondary test. The secondary test, you can call it a secondary test if it doesn't go lower from the SC, which is the selling climax. So either the secondary test can create equal lows, which creates liquidity, or a way higher, a little bit higher above from the SC, the selling climax. So let's just put this here, which is creating equal lows. So this is the SC, selling climax. We have the AR, which is usually never above the PS or the preliminary support. Then we have the ST, which is the secondary test, which should never be below SC. So if it's below SC, then let's just create some liquidity here, some trend line and stuff. Then if an ST goes below an SC or the selling climax, then now it's called an STNB, because an STNB is called an STNB if it goes lower than the selling climax or the secondary test. Basically, what the STNB or the secondary test in phase B is doing is basically grabbing all the liquidity from this trend line here, trend line here, got some trend line here, we got some equal lows here. Basically, grabbing those stop losses and those breakout traders. And then after the STNB, we then move up to create a liquidity, to create liquidity channels, to create trend lines and stuff, flag patterns, bull patterns. We create equal highs here. Then it does create the spring. Now, when do we call it a spring? The spring is usually, no, the spring must be lower than the STNB or the secondary test in phase B. You don't call it a spring if it doesn't go lower than the secondary test in phase B. So basically, we have that spring, then we have some choppiness, 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 then it breaks higher than all these highs here, which is, we call the validation point. Or basically, this is the part where we call it that it's a valid Wyckoff. So let's just mark this up. So this is the PS or the let's just call it PS or the preliminary support. Then we have the SC, which is the selling climax. Then we have the AR. You remember that the AR usually doesn't go higher from the highs of this PS, the preliminary support. Then we mark up the ST, which is the secondary test, ST secondary test. Remember that it's called secondary test if it doesn't go below the SC or just basically creates equal lows. Because the job of an ST is basically to create liquidity. Then after the ST, we have some choppiness here, which is just some flag patterns and funnel and trend line to create liquidity. And after that, we have the STNB, which is the secondary test in phase B. Why do we call this a secondary test in phase B? Because the job of the secondary test in phase B is to take out these equal lows or any lows here. Basically, the STNB takes out the selling climax and the ST. Then we have a pull up, which is usually doesn't go higher than the AR, or it could go higher a little bit, which is a sign of strength. Call this a sign of strength here. It shows that, oh, I'm having strength to push higher, to push the price higher. Then It also grabs those breakout traders, or though we have stop losses here from people selling on this point, selling on this point. They put their stop loss here since it's like a structure point. But basically it's just another liquidity grab. As soon as it spikes up, then it grabs down to grab liquidity from this point, and others from basically buying, which are called breakout traders. And after that, we create the spring. Let me just erase this. Create the spring. Why do we call it the spring? Or how can we identify if it's the spring? Well, basically the job of the spring is to take out the ST and B. So the pattern is SC, ST, which doesn't go lower than the SC or the selling climax. Basically it's just creating liquidity, equal lows, and ST can also be somewhere here. Then we have an STNB, which basically takes out those equal lows or liquidity on this zone. Then next we have the spring, which it does, or what it does is basically take out these liquidity zone, or basically equal lows here, or these lows, or this trend channel and stuff. So that's the job of the spring. Then we have a move higher up. Then we have this last point of support, where we usually enter. Since if you look at this, it's a down move, then an up move, so basically an order block, the last down move before the up move. Then after the schematic, we then have a push up, which is we call a markup. Now there are two schematics on Wyckoff. So this is what we call accumulation. Wait, let me just. So this is what we call an accumulation. This is a schematic one. So what I mean that we have two schematics is we have a schematic tool. So the schematic tool looks like this. Push down, move back up a little bit. Then we create. Let's just replicate this this moves here. We have the PS, preliminary support. We then have the SC, selling climax. AR, ST could either be here or equal lows. Basically it should never go down the SC or the selling climax. If it goes down, then we call it the STNB. Then we have the STNB. Then we break structure above. Then we push higher, mark up. So let's just mark this up. We have the STNB. We have the ST. Then we have the SC. So what's the difference? We don't see a spring. So basically STNB is basically the spring. Okay? It's basically the spring. This is schematic 2, schematic 1. So these are still called Wyckoff, but they're not the same because this one doesn't have a spring or just has STNB. Basically the STNB is the spring. So how do you validate Wyckoff? So how do you validate Wyckoff? Wyckoff is valid as soon as you break structure from these points up. So from the AR. So this could be another liquidity grab, but let's just simplify it. Let's put it here. So as soon price went above higher than the AR or the automatic rally, basically it's now a valid Wyckoff. Let me show you again. So price went down, PS, SC, AR, ST, STNB, the spring, then move higher. Then this is what we call a valid Wyckoff since it broke above these structures, the price point here. Because if price doesn't break that point, basically price, let's say price is still below, because right now we see the spring, the SC, selling climax, the secondary test or the ST, secondary test in phase B, then we see the spring. The reason why we wait for the validation for it to be called an accumulation, because if price doesn't break here or these highs, price could basically still form here. So basically it could still form another spring, or maybe this is the real spring. Then wait, let's move this slower. Yeah, basically this is the real spring. Now let's say price break. So we had this anticipation, right? This is the spring, STNB, the selling climax, and the secondary test. Now, since it didn't validate it yet, it didn't break these structures or these highs. So basically this is not a valid Wyckoff. Basically it's still forming. So since we didn't validate it, it's not valid. So look at price now. We have the real spring, we have the real STNB. Now this looks like the selling climax now, this area, and this could be just some noise. Then price could break it. Let's say price broke there, then this is a valid Wyckoff. Basically, if it breaks above these highs, basically the names of this don't change anymore. Okay, so if it didn't break that above that high, then we could have another spring, right? Since it's not a valid one. So that's this is accumulation, phase 1 and phase 2. Schematic 1 and schematic 2, my bad. Then it's the same, this is accumulation. Then same with distribution, we just flip it. It's the same thing, invert scale. Now we have, basically wait, let me just erase this. Basically we have a distribution. But the distribution has a little bit different names, but basically you can look at it as the same as an accumulation. So basically, instead of the selling climax, we have a buying climax. Then instead of so basically it's still an ST here. Then instead of a STNB, we'll have a UT or the up thrust. Then instead of a spring, we'll have a UTAD or up thrust after distribution. And it's the same thing here, AR. And this is instead of preliminary support, we call this now a PSY or preliminary supply. Wait, let me check. I think it's preliminary supply. Yes, it is. Then instead of sign of strength is basically changed to SO or sign of weakness, because we want price to push lower. Then it's the same thing. We have the schematic 1. Then we have the schematic 2. Schematic 2 is so BC, buying climax, still an ST. Then instead of an STNB, we have the UT, and we don't have the UTAD. Basically, the UTAD is the spring. So UT, yeah. So we only have the UT. Then price breaks these lows here. Wait, let's put the PSY. PSY breaks lower. Then as soon as it broke that point, we look for an order block here, which is the last up move before the down move. Order block there. Then we enter here. Now, here's the thing. Wait. Oh yeah, so that's the basics of Wyckoff. Wait, how can I not? What's happening? Sell. What? It's not letting me place cells. Oh lol, it's inverted, my bad. So yeah. yeah, we just do this and enter there. The price is it's inverted right now. So yeah, that's the basics of Wyckoff. Now the thing is that I see that people do. So we know the pattern, right? Basically, Wyckoff is a pattern. Now the thing is, yeah. Now the problem with people is they use Wyckoff as a indication of where price is going. So if we see a distribution here, they say, oh, it's gonna push down. Wait, let's go on lower time frames. Oh, we see an accumulation, price should push up. Oh, we see a distribution, price should push down. Oh, we see a, what is this, in a redistribution. Oh, price should go down. Accumulation, distribution, accumulation, distribution. But the thing is, if you look in lower time frames, there's Wyckoff everywhere, or basically schematics everywhere. So if we look on this, accumulation, I see accumulation there. On lower time frames, accumulation, distribution here. There's distribution here, accumulation here, distribution, accumulation, redistribution, distribution, accumulation, accumulation, distribution, distribution, accumulation, distribution. Then if you see that, that's a lot of schematics. Then basically, the thing is you can't really trade Wyckoff alone, because if you take all those trades, you're gonna get screwed. So remember that Wyckoff, you don't use Wyckoff as a sense of direction or as an indication that where price might go. So we don't say like, oh, there's a distribution here, price is gonna push higher. No, we don't say that, or we don't look at Wyckoff like that. Oh, we see, oh, a huge accumulation. Oh, this could be accumulation. This could be the UTAD. This could be the UT. This could be the buying climax. Now we're waiting for price to break the buying climax. Buying climax, and we have the AR here. So we're waiting for price to break it, to validate it, because we're gonna push lower. So what people do, or new people do, or people who are new to the Wyckoff schematic patterns or concept, is that they mark this up even though it's basically still not valid, or they mark this up, oh, it's probably a distribution, price is gonna go down. No, you don't use Wyckoff as a sense of direction, but you use Wyckoff as confirmation. Now basically most of the people here, already saw me how I trade. So basically how I trade is I use Wyckoff as confirmation. So what does that mean? So let's just say I see an order block here, this huge order block zone. Then I look at then after I find a POI or an order block, I then wait for Wyckoff, or basically Wyckoff as my confirmation. I just don't enter blindly like this. Let's just have a buy limits, then we enter there, then boom, the price goes to the moon. No, but what I do is I wait for Wyckoff, or use Wyckoff as my confirmation. So right now, either this could be a selling climax and it's going lower, so probably this could be a selling climax, price could push higher, then create that certain pattern. You have the spring here, then we have the markup. That's how I use Wyckoff. Oh wait, no, spring, or the price shouldn't go below the order block, or basically it invalidates everything. So yeah, so that's how I use Wyckoff. I use it as the last confirmation for my strategy. I don't look at Wyckoff, oh, Wyckoff here, price is gonna go down probably. No, I don't use that. I don't look at that. I use Wyckoff as confirmation. So find a POI, look for Wyckoff. If there's Wyckoff, if it breaks these highs, then we enter there. So we have an example here. There's an example here. I think it's on the 15 minutes. 30 minute, I guess. No, 15 minute. So we have an OB here. So for example here, we have a POI. So let's just say I was here. I was looking to buy that order block, right? Since let's just say we're in a bullish market. We're bullish on EU, for example. Now we go on the lower time frames to look for the Wyckoff or accumulation basically. What do we see? Then it go higher and boom. Instead of buying blindly, instead of just putting your buy limit here, which is still fine, but this is why I use Wyckoff as confirmation, because you see that price just broke through. Because what do we see? This could be the selling climax, this could be the ST. Now we're waiting for the spring, but the spring went lower from the order block, which is now an invalid order block. Let's just say let's say the order block was here, then let's say price went up here, broke the AR. Now it's a valid schematic. Then we enter, then we look for order blocks in this inner zones, then we look for order blocks in this inner zones, then we enter from there. So order block here, then I set my buy limit, then bring it higher since I already have my confirmation. Now, so yeah, that's how I use Wyckoff, because if I use Wyckoff for like a sense of direction, I'd be screwed, right? Because you see I'll give you an example. You see an accumulation here. You have that selling climax, the ST. Then this is a schematic tool because we don't have a spring, we just have an STNB. Then break structures here. Then it's a valid Wyckoff. So accumulation. And after that we have a distribution. After that we have another accumulation. Then we have distribution. Then price drops. Now if we look closer, go on lower time frames, say on the 5-minute, we see that there are more tinier schematics inside those larger schematics. That's why you don't trade Wyckoff alone, because there are multiple setups. So accumulation here, you see this tiny reaccumulation, distribution, accumulation, accumulation here, this is the spring, this is an SC, accumulation here, reaccumulation, distribution, accumulation, distribution, accumulation, distribution, accumulation, distribution. Basically, you're gonna get screwed. Look at that. You don't want to trade all of these. You're gonna get screwed. So that's why I only use Wyckoff as the last confirmation for my entry. So basically all of you have seen me share my charts before. If you notice, wait, let me show you my charts. If you notice, do you see any Wyckoff markups? Do you see that I marked this up as a UTAD, UT, BC? Or do you see, wait, let me erase this. Do you see me mark up a UTAD, UT, BC? I don't, because I use Wyckoff as a last point of confirmation. So instead of looking Wyckoff first when you look for entries, you look at Wyckoff at the last part. Okay, so you just look for a POI. We have an order block here. Oh, I want to buy that. Then we wait for a confirmation. So we wait for a Wyckoff pattern or a schematic. So we wait for Wyckoff there, and push higher. So that's why I don't mention Wyckoff, or I don't look for Wyckoff first. I just look for Wyckoff at the last point, since that's the more efficient way, and that's the way, or for me, that doesn't confuse me a lot, since technically there are multiple Wyckoff or schematics here. Then I'll share it again. Remember the Snowflake Rule. What is the Snowflake Rule? I'll pull up my screen. So what do you call this? A snowflake. 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 Now, what do you call these? Basically, there are snowflakes with different patterns in them. Even though they're not the same patterns, even though this one is like triangle, this one is circle, it's a bunch of circles. Even though they have different patterns inside them, they're all still called snowflakes. So how does that relate to Wyckoff? Let's go back to EU. What I mean is, you don't need to look for the perfect schematic. This one, do you guys see that? Yeah, you see it? Okay, you don't look for the perfect schematic. You don't look for the PS. You don't look for the complete schematic. You don't look for, let's just say you want price to always look this good. Okay, schematic 1. So you want a PS, preliminary support, an SC selling climax, AR automatic rally, ST secondary test, ST in phase B, spring, sauce, BU, LPS test. So basically you're looking for that perfect pattern, but there's none. It's rare. You're gonna get screwed. So what I mean by the Snowflake Rule is, simplify your view of Wyckoff. Basically, If it looks like this, spring, then that's Wyckoff. Okay. Oops. Then that's Wyckoff. Look at this. Wyckoff. 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 They look very different. They all look different, but basically, as soon as it breaks these highs, remember these highs, then it's a valid Wyckoff. So it broke those highs. Look at that. So it's a valid Wyckoff, but they don't look the same. That's what I mean by the Snowflake Rule. Is they're basically all schematics, but they have different patterns inside them. Hence the Snowflake Rule. So yeah, that's what I mean by the Snowflake Rule. So simplify your view of Wyckoff. As long as it has the SC, spring, then you're good. That's all you need, SC and spring. So that's why I simplify my markups when I see Wyckoff like this. SC, UT, oh no, BC, since it's a distribution, buying climax, up thrust, UTAD. You don't need to mark up a SO, you need to mark up ST, 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 AR, AR. You don't need to do that. You just have to simplify it, since it's not really that hard, or it's not really that complicated to understand. See this SC, then the ST and B, or basically the ST and B is the spring. This is a schematic tool. That's Wyckoff. See this, the UT, the UTAD, and the BC. That's it. Simplify your view on Wyckoff. So yeah, I think that's it for now. So basically, don't complicate Wyckoff. It's very simple. Don't even need to memorize these words. You just remember that basically Wyckoff is a break of structure. You look at it, price did this, did this, did this, did this, did this, did this. Remember, it's a valid Wyckoff if it breaks these highs, right? So if it broke that high, then it's a valid Wyckoff. Then we look for order blocks to enter. Then we take it higher. Let's say there's an order block here. And then we put a buy limit here. Then basically what that means is Wyckoff is basically just a break of structure. If you look at that, structure zones, broke this structure, then it's a valid Wyckoff. Basically, it's just a break of structure. So yeah, I think I'm done with a beginner's guide to Wyckoff. So